Many of my viewers have been asking for me to do a discounted cash flow valuation analysis of Lyft, considering that I have Uber rated as my number one stock to buy in 2025. Understandably, my viewers were curious what I thought about Lyft. So you're going to find out here in this video after I conduct my discounted cash flow valuation what I think of Lyft. Do I think it's undervalued at current prices? You'll get the answer to that question here.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
All right, so my discounted cash flow valuation starts with the 2024 free cash flow expected according to Wall Street analyst. Lyft is expected to generate 620 million in free cash flow in 2024, and that's expected to rise all the way up to 770 million by 2028, which would be a 5.5% expected growth rate in free cash flow. Nothing extreme. The transition period between 2029 and 2034, I forecasted the company's growth rate in free cash flow remaining the same at 5.5%, and then settling down to a longer term growth rate of 5%. So my expectations for Lyft's free cash flow growth over the next decade and more are roughly 5%. All right. I don't expect anything great in terms of free cash flow expansion from Lyft. All right. When I take the present value of all those free cash flows from 2024 to 2034, it totals $4 billion. From the time period of 2035 to infinity, I used the terminal value calculation shortcut, and it delivered an $11.8 billion value for its free cash flows expected between 2035 and infinity. The present value of this terminal value is $3 billion. So when I sum up the total of the value of operations, the present value of all the free cash flow, I arrive at $7 billion. The weighted average cost of capital I'm using for Lyft is 14.4%, which is relatively high. I'm arriving at that with a cost of debt of 7.5% and a capital asset pricing model cost of equity of 16.74%. The beta is 2.04, risk-free rate of 4.5%, and a market risk premium of 6%. Now, I use a bit of a counterintuitive model for market risk premium. Some analysts like to use a lower market risk premium when the stock market is in a bull market and has rallied and valuations are high. And then they like to use a lower market risk premium when the valuations are lower. I'm kind of the opposite. When valuations are higher, I like to use a higher market risk premium because I'm more nervous about investing in a market that's bullish. I'm more nervous about investing in a market that has so much enthusiasm like there is now, right? Besides the sell-off yesterday that was fueled by developments in a Chinese AI company, stock markets have been booming for the last 2.5 years. And so with valuations on the higher end of historical averages, I'm a little more nervous about a correction. And so I apply a higher market risk premium in these times, right? If we were to go into a big sell-off, let's say a 25-35% sell-off, I would lower my market risk premium. I feel more comfortable investing my capital in those markets where investors are hesitating before putting in capital, where there's more opportunity to find stocks at better valuations. So that's just my thinking with the market risk premium number. Analysts use numbers between 4 and 6%, and I'm at the higher end right now at 6%. So this means that the valuations that I'm getting for my discounted cash flow models are lower than if I were to use 4%. The valuation would be higher. So they're inversely related. A higher market risk premium lowers the intrinsic value per share calculation. A lower market risk premium raises the intrinsic value per share calculation. So Lyft's market cap is 5.7 billion and the total debt is 1.1.5 billion. So given that, I applied a target capital structure of 25% debt and 75% equity. A business has to finance itself with one or two sources, and those sources are debt or equity. A business usually has a choice in how much debt and how much equity it deploys. Some businesses don't have a choice because they're in desperate situations. They have to take what the markets will give. Other businesses like Lyft that generate healthy cash flow, they have choices on how they want to finance the business. All right. So now that we talked about the present values, the discount rates of the cash flows, let's arrive at our intrinsic value. So to the total of the value of operations, we need to add the company's cash at 1.9 billion, subtract the debt of 1.1 billion, and we get a value of equity at 7.9 billion for Lyft. But we want to know the price per share, so we're going to divide that by the number of shares outstanding of 412 million, and that brings us to an intrinsic value per share for Lyft at $19.09. Right? That's a big increase, or that's a big difference between the current market price of $13.74. So according to my calculations, I think Lyft stock is undervalued. And it's similar to what I came to the conclusion about for Uber stock, and I felt Uber stock is also significantly undervalued. The big reason that these ride-sharing companies are undervalued is because of the threat of driverless car technology and how it's going to impact this company's future potential. I've felt that those risks are overblown. I think the driverless car technology is going to take longer to develop than is currently expected by the market. And when it is developed, I think the uptake is going to be much smaller than what the market is expecting. The market expects everyone to use driverless cars. I don't think everyone's going to use driverless cars. I think the market is going to be much smaller for driverless cars than what is currently expected by stock market participants. So that threat from driverless technology is depressing Lyft stock because it is a risk. It is a risk that you need to consider. And so when you're looking at this business, that's the big downside. That's the big thing that you need to find yourself and decide for yourself what you feel. Do you think driverless car technology is going to kill Lyft's business? If you think that's the case, then you should not be entering into Lyft stock. But if you think the forecasts for driverless car technology are overblown, like I do, then maybe Lyft might be the right stock for you as well. Hey everyone, I'm excited to announce that my book is finally available for sale. I've been working on it for more than a year now, so I'm really excited to finally share this with you now. It goes through my framework for evaluating stocks. Some of you often ask why I like this stock or why I like the other stock, and this framework provides you the things that I look at when I'm evaluating stocks. I've added the link in the description below.